what is going on is there's been a flight of deposits leaving the smaller banks in the banking system. That amalgamated in Silicon Valley Bank and Signature Bank going under over the weekend, but a ongoing run on the banking system. Now, a run now has changed somewhat. Obviously, the authorities have stepped in and said that they will guarantee depositors and also help with the mismatch of duration, which is banks borrow short and lend long, but their bond portfolios are underwater, even though they're just invested in treasuries. And if depositors leave, they have to unwind some of that part, which is the long part, and they're underwater. So suddenly they create these huge losses, and that's the systemic problem that's going on.
The collapse of Silicon Valley Bank had a widespread impact on global bank stocks, causing shockwaves on Tuesday. Despite reassurances from President Joe Biden and other policymakers, concerns about contagion persisted and led to a reconsideration of the interest rate outlook. On March 10th, SVB Financial Group, a startup-focused lender, became the largest bank to fail since the 2008 financial crisis, sending global markets into disarray. Although banking regulators announced on Sunday that SVB depositors would have access to their funds on Monday, fears remain that startups would struggle to pay their employees this week. President Biden addressed the banking crisis on Monday and hinted at new regulation of banks, but he faces a divided Congress unlikely to approve tougher rules. State regulators also closed New York-based Signature Bank on Sunday, marking the third-largest failure in U.S. banking history. However, customers outside SVB's Santa Clara headquarters were reassured by a Federal Deposit Insurance Corporation employee that they would be able to transact business as usual. To help you understand what occurred, its impact, and what we can expect next, Real Vision co-founder and CEO Raoul in this video discuss what is happening and why this all matters for crypto. Before we listen to him, please don't forget to smash the like button and subscribe to the channel if you are yet to do so. Thanks for watching our videos. We appreciate you so much.
Now, what was happening is people were being incentivized to flee because they're seeing what's going on, wondering, am I going to get my deposit back? So the answer is go to a different bank. JP Morgan wins the world as everybody moves over. So they tried to stop that, saying, hey, listen, your deposits are safe. So they've kind of underwritten the entire banking system and also underwritten these mark-to-market losses as deposits leave the system. Okay, all well and good. The issue is it's ongoing. This is not resolving the real problem, which is the deposits are still leaving the system. They're leaving the system for two reasons. One is economic slowdown. So everyone draws down on their cash balances over time. And secondly, the small banks are offering 0.5% interest rates on deposits, and CDs are offering 5%. So money just goes to the CDs. And so that's deposits leaving the system, and this continues. And the reason why deposits are 0.5% and not 5% is the yield curve is so inverted. So therefore, they can't borrow short, lend long. So they have to kind of falsely create a yield curve where it's 0.5% so they can then lend it out. So that's the problem that they're facing. And that's why the banks remain under pressure today, because actually the issue is here, strip out all of the idiosyncratic risks from all of the banks, is the yield curve is too inverted for the banking system to make money. And so the share prices remain under pressure and the depositors keep leaving. So what we end up with is negative equity in the banking system. So it's a bigger problem than people understand. My entire view here is that they're going to have to steepen the yield curve and cut rates and probably do QE as well. So I think that's on the cards to come. I know everybody thinks the inflation's sticky. I think a banking crisis is the single most important marker of a deflationary process, and is deflationary in its own right because bank lending reduces rapidly. So that slows down the economic growth. Also jobs start, people start getting laid off because there's no access to capital. So all of that process is underway. Why does it matter for crypto? Sorry, it's a bit of a soliloquy here, but why does it matter to crypto? The crypto market is driven by, firstly, this is part of this choke point 2.0, where anybody who has access to the crypto market, any bank, goes under, but it's much bigger than that. So they think it's going to be that, and it looks like it's a smart move. They can get Signature Bank out and Silicon Valley Bank and Silvergate Bank out. But the actual issue is the next one is Republic or First Republic or whoever it's going to be, right? Because they've all got the same problem. So it's actually a system-wide issue. So, okay, if they're blocking crypto out of the system, and this is the banking system creaking at the seams, why is crypto rallying? Well, pretty straightforward. A, you can't get your money out. And we've seen this periodically, and that tends to keep money in circulation within that system. But secondly, crypto is a function of liquidity, and it's forward-looking. I've been saying this for a long time. Is the crypto markets figured out that, and much like the kind of long duration assets of technology, figured out that the Fed will have to pivot at some point, and that Fed pivot is positive for whether it's money supply growth or the Fed balance sheet over time. And that's why crypto does quite well in this environment and tends to outperform. We saw similar when the Fed stopped in 2018, December 2018. The next year, crypto was up 300%. Equities were up. Technology was up 25%. The S&P was up 15%. So net, there's a negative force of this forcing people out of crypto. There's a massive negative issue with what's going on in the banking system, and that will continue until they start cutting rates aggressively. And it's positive for risk assets over time because more cowbell.
Raoul Pal also discussed the reaction of the market to the crash of the U.S. banks. The crash also had some global impacts that affected other markets outside of the United States. In Britain, HSBC bought the UK arm of Silicon Valley Bank for a symbolic £1 on Monday, rescuing a key lender for technology startups in England. The sell-off in global banking stocks continued in Asia on Tuesday, following a brutal sell-off on Wall Street the previous day, with shares of JP Morgan Chase & Co., Citigroup, and Wells Fargo all losing ground. Japan's financial stocks led losses in Asian trade, while in Hong Kong, shares of HSBC fell to their lowest since January 12, tracking declines in the London-listed counter. The dollar weakened as markets bet the Federal Reserve will slow, if not halt, its raising of interest rates to curb inflation after the sudden collapse of Silicon Valley Bank. According to the Globe and Mail, Canada's banking regulator announced on Monday that it was increasing its monitoring of domestic banks' financial health following SVB's collapse. Let's hear more from Raoul Pal.
Well, the market's figured out the issue, which is that even if you underwrite the depositors, the problem still remains. Hence, the CRE index keeps going down, the smaller banks index, the regional banks. So that doesn't stop. And the 2-year treasuries are like, yeah, you've screwed this up, rates are too tight. And that has to get unwound, because there's nothing like a banking crisis to tell you where the rates are at the wrong level. I mean, it's classic stuff, right? I've never seen a banking crisis without a rate cut ever in history. So that's what the market's figured out very fast, is that strip away all of the noise, rates are too high for the banking system to deal with.
Raoul, I know you've got to run, but I want to ask you one other quick question. Since this is a crypto show, could this be the moment that folks, particularly in the Bitcoin community, have been talking about, where we see digital assets begin to become an alternative, at least at some level, or a flight to quality play, an off-the-grid storage mechanism, the digital e-gold use case that so many Bitcoiners are so passionate about? Could this be that moment?
Well, look, I first got into Bitcoin in 2013 for this very reason, because I lived the European banking crisis, which is very similar to this. And we realized that nothing we owned in banks was ours. And even if they backstop the system, it backstops it with monetary printing eventually. So that lowers the value of your assets over time. So you're kind of trapped into this. So Bitcoin was the answer that I saw then. And that's why I got into the whole thing at that time. That case is still here. Now, they have guaranteed the deposit base. So it's not as obvious that you're going to lose your money by keeping it in the banking system. So it's not a no-brainer. But the understanding that to offset what they're doing, right, there's always a payment for something here. An eventual payment comes down the line is that it'll end up on the Fed balance sheet, and or monetary easing, and therefore scarce supply assets tend to do better. And so crypto does well. So yes, I mean, it's exactly what it was built for. I mean, don't forget, in the white paper itself was the thing about the governors bailing out the banking system again. These aren't bailouts, but they're still a use of monetary policy to paper over cracks in the banking system, which is still comes down to the one thing, is we have too much debt. In debt, when you've got too much debt, you end up with rolling crises of different types. And crypto had created its own crisis by creating leverage on top of itself, which is a dumb thing and an 80-volt asset. But at core, if you can just take an asset and stick it like you can with gold and you can with essentially T-bills and Treasury Direct, you're safer. But Treasury Direct, the value of the purchasing power of your dollar over time due to the effects of the increase in balance sheet are reduced. And therefore you want to be in things that don't get reduced in value as more money comes into the system.
Yeah, it's always the leverage. This is what crypto is built for. This is what Real Vision is built for. Raoul, I know you've got to jump to some Texas meetings. Final thoughts before we lose you.
Yeah, this is exactly, we've been doing this whole series of how to unfuck your future. The part of why the future is so screwed up is because of the leverage. And the leverage is a function of demographics. The leverage is a function of a number of things that we've gone through on Real Vision. The point being is digital assets have a role within this. They're not for everybody, but this is a crypto show, so a lot of people watching this are actually interested. Other people will find other ways to navigate this. Some people will traditionally use gold, and that should be fine too. So keep your eye on the situation as it evolves. Not your keys, not your coins. Keep everything as you can out of the system. Realize that they're trying to close the fiat on-ramps and off-ramps as well to crypto, because that's another part of this whole equation. So just make sure you're all set up and carefully balanced for what comes out.
On Monday, the value of cryptocurrencies, such as Bitcoin and Ether, rebounded after experiencing weeks-long lows on Friday. This rally was part of a larger trend in the cryptocurrency market as investors react to the fallout from the collapse of Silicon Valley Bank and growing concerns about a potential financial crisis. Bitcoin, the largest cryptocurrency by market capitalization, was trading at around $22,300 on Monday morning, up approximately 9% from the previous day. Meanwhile, Ether, the second largest cryptocurrency, was trading at nearly $1,600, up almost 7% from Sunday. Other major cryptocurrencies, including Binance's BNB, Cardano's Cardano, and Solana's Sol, also experienced gains of between 4% and 8% on Monday. Stablecoin USD Coin USDC, which is supposed to be pegged to the US dollar, was trading at $0.99 on Monday, largely recovering from losses over the weekend after it lost its dollar peg and fell as low as $0.88. Mike Fay, the author of Blockchain Reaction, stated that the collapse of Silicon Valley Bank and Silvergate, as well as the 2013 Cyprus banking crisis, serve as a reminder that not your keys, not your coins is a lesson that must be learned repeatedly. Banks are capable of making bad decisions or investments, even in regulated environments. Due to the uncertainty in the traditional banking sector, crypto, particularly Bitcoin, remains a safe and sound investment. Thank you for tuning in.